Morning, everyone, and welcome. My name is David Warnicker. I'm a tax partner at BDO and the head of Tax Technical here. I'd like to thank you all very much for joining us today for our annual tax update presentation. In case I ever needed reminding of it, I was reminded on the 30th of October, which was the medium-term budget day, that tax is never a dull discipline. On that day, the Minister of Finance tabled 6 tax bills, no fewer than 6. And those were the Rates and Monetary Amounts Bill, the Taxation Laws Amendment Bill, Tax Administration Laws Amendment Bill, the Revenue Laws Amendment Bill, which deals with the two-pot regime, Global Minimum Tax Bill, which deals with the income inclusion rule and the 15% minimum global tax, and the Global Tax Administration Bill. In this presentation, we're going to cover the most important, by no means all, but the most important amendments that are contained in what we believe to be the most important bills of the year that affect the majority of taxpayers. Those are the Taxation Laws Amendment Bill and the Tax Administration Laws Amendment Bill. We'll also be considering some of the most important tax cases that have been considered by our courts in the last 12 months. Please bear in mind that these bills have not been promulgated yet, so it is possible that there may be changes to the bills, but it seems somewhat unlikely to us. Now, just a word on the slides. The slides are deliberately wordy, and they are intended to function both as notes and slides, so they're not the usual point form type slides that one often sees in presentations. And a copy of the slides will be sent to you after the presentation, so you'll hopefully have some notes to take away at the same time. But just bear in mind the wordiness. So if a presenter moves on to a topic, then I think rather focus on what the presenter's saying rather than starting to read the slides, and hopefully you'll get more information out of what the presenter's actually saying. If you remain on the presentation for the full duration, then a CPD certificate will also be sent to you. I'm joined in my presentation today by the following speakers, and I'll introduce them in the order in which they're going to present in the presentation. So first up, we've got Denisa Sihau. Denisa is an Associate Director in our tax consulting practice and is the head of our Global Employer Services division. Then we'll have Louis van Maanen. Louis is a tax partner who specializes in corporate income tax. Then Hilton Cameron. Hilton is a tax director who heads up our corporate international tax division. And then we will have Cliff Watson. Cliff is a director in our indirect tax division and specializes in value-added tax, VAT. And then I will present. As mentioned, I'm a tax partner and the head of Income Tax Technical. With regard to questions, you should see the Q&A function in your on your screen, and please feel free to post your questions in that box. We'll do our best to respond to the questions as we go along in the presentation. So without further ado, let me hand over now to Denisa, who will deal with the proposals that relate to individual savings and employment that are contained in the Taxation Laws Amendment Bill. Over to you, Denisa.
Good morning, everyone. Thank you, David, for the introduction. As David has stated, we will be focusing on the most important changes that came through from the minister. This time around, from an employee's tax, retirement and savings, there hasn't been quite a lot of changes, but we picked the top 3 important sections that we felt are critical at this point in time. And The first one being the employment tax incentive. This has been SARS's pain point when it comes to employers, where there have been quite a number of changes. In the previous years, there was a definition in the changes in the definition of what an employee is. But what SARS has done now in this change, if you can show the slide, Sibo, is with regards to actually putting specific penalties when it comes to ETI. And what this means is that where we've had these various schemes that employers have embarked on, where they would have individuals actually studying and not really providing employment to the youth, what SARS education and training, and not really a salary or a cash amount given to an employee. That ETI claimed. What this is showing us is that SARS has actually put in measures to ensure that when one is claiming an employment tax incentive, the individual is actually employed, and secondly, is actually rendering services and not embarking on a training course or studying. And therefore, only the cash amount should be used in determining the individual's remuneration, and any amount that is being paid to an educational institution cannot qualify as ETI. And if an employer has actually claimed ETI in respect of that amount, there will be a penalty that will be levied. And this penalty is over and above the normal penalties around understatement penalties, late payment penalties, because what happens is that if there is an audit and SARS comes in and finds that there has been ETI that has been claimed in relation to training and education, they will firstly deny that ETI, which means that the employer would have underpaid PAYE. They would then have a late payment penalty, and therefore there's a potential of one, an understatement penalty, two, a late payment penalty, and thirdly, now over and above that, 100% penalty in relation to the ETI amount that has been claimed. This is really SARS stating their intention of clamping down on these various schemes when it comes to the employment tax incentive. Then the next change is in relation to trusts that especially foreign trusts, where an individual is actually making interest-free loans to a foreign trust and they are connected parties. So we can go to the next slide. This is in relation to the overlap between Section 7C as well as Section 31.3, which is transfer pricing adjustment. And currently, the concern is that where there is an overlap and Section 31, which is the transfer pricing adjustment, is applicable, then Section 7C would not apply. But what this means is that if you're looking at an arm's length transaction, because what Section 31 looks at is an arm's length transaction, and if the arm's length transaction, if an arm's length transaction has been entered into and the interest being charged is at arm's length, however, that is still lower than the South African official interest rate, that means that the fiscus is losing. And therefore, the change is to ensure that the shortfall between the official interest rate as well as the arm's length interest rate is then caught up by deeming the amount back to the individual that has actually advanced the loan. The next slide actually illustrates this by means of an example. When we say there has been a loan, my example is if there is actually a 10 million rand loan provided to an offshore trust by an individual, and assuming a market-related interest rate is 5% in the country where the trust is actually located. However, the South African interest rate is 8%. Currently, what the law says is that if you were to assume 5% interest rate and it is at arm's length, Section 7C would not be applicable. However, where you now have a loan which is interest-free and the arm's length is 5% and the official rate is 8%, you now have about 3 adjustments. And the first adjustment is that if you're looking at a 10 million rands loan and at 5% interest and the loan is interest-free, you have, from a Section 31 perspective, a primary adjustment which says that the 500,000 rands that would have been interest had it been charged will be an adjustment in the taxable income of that taxpayer that has advanced that loan. And there's also a secondary adjustment of the same 5%, which would mean that that 500,000 will also be deemed to be a donation. Currently, as the law stands, that is where it would stop, because the law says that if Section 31 is applicable, you don't apply to Section 7C. But what this change now does is that because it states that up to the arm's length, you would apply Section 31. Now, because the arm's length interest rate is 5%, which is lower than the official rate of interest, we now have another adjustment, which is a third adjustment, which then says that the 300,000 rands, which is now over and above the 500,000, which is arm's length, would now be deemed to be a donation in terms of Section 7C. So the fiscus is trying to catch up to say, yes, we understand that South Africa's official rate of interest may be higher than other countries. And if, for an example, Section 31 has been applied, we still have the option of applying Section 7C in any amount that is over and above the arm's rate interest. And therefore, this is a change that would mean that there would be 3 applicable adjustments to the interest-free loans to foreign trusts by South African tax residents. Then the last change that the minister also announced is really just an alignment with regards to retirement funds. If you can go to the next slide as well. So recently, there has been a lot of alignment between all the retirement funds, where we know there were various treatments when it came to pension and provident fund that was aligned. However, the retirement annuity funds were left out in the cold, in that one could actually move from a pension fund to a provident fund or vice versa, as long as the rules remain the same. And they would be in a tax neutral position. However, the retirement fund were left out, and there were unintended consequences in that most of your retirement funds, one would reach retirement age at the age of 55. However, they would not withdraw or retire. They would maybe continue to be part of that fund for some time to come. And therefore, there would be unintended consequences in that at the age of 55, on transfer after reaching normal retirement age, then there would be tax payable. What the proposal then says is that if one member is moving from a retirement annuity fund and transfers to a pension or a provident fund, they will also be in a tax neutral position, in that there will be no taxable event up until they actually retire from that fund. However, members will not be eligible to withdraw from the fund if on the amount transferred, but they would be governed by the rules of the fund that they've transferred to. So all this means is that if you have not actually withdrawn or actually retired from your retirement annuity fund, but all you've just done is just moved your funds from a retirement annuity fund to a pension or provident fund with similar restrictions in the 1/3, 2/3 split, you should not be in a worse off position by means of actually paying tax. And this change will be effective from the tax year 1 March 2025. And that's it from an individual's tax, PYE, and retirement funds changes. I will now give Louis to take us through the corporate income tax changes.
Great. Thank you, Dumisa, and good morning to all our clients and our colleagues. While Dumisa was talking about retirement age, I couldn't help but reflect and wonder whether I would get when I would get my 15 minutes of fame and whether that would happen before I retire. Anyway, with 376 people attending at the moment, and the fact that my presentation happens to be 15 minutes, this might just be it. But without any further ado, Sibu, if we can go to the next slide, please. So our first topic is the narrowing of the definition of connected persons when it comes to limited partnerships. So let's just spend a moment on understanding limited partnerships before we jump into the detail. So for those of you who may not know or may have forgotten, a limited partnership, which is also referred to as an on-commandite partnership, is typically a partnership used for investment vehicles, and it normally has a general partner which is known to the public. It's sort of the face of the partnership. That's the partner that signs agreements and transacts on behalf of the partnership. And then the other partners are referred to as limited partners or silent partners. And their liability to the partnership is limited to what they put in as capital into the partnership. So the term silent partner should, of course, in this context, not be confused with a person giving their partner the silent treatment as a means of expressing dissatisfaction. We are talking about business partners here. So currently, the connected person definition of a partnership is extremely wide. It includes all partners in a partnership as well as a foreign partnership. And it also includes persons who are connected to those partners that are then also connected to the other partners. And the relevance of the connected person definition is quite important in our legislation because numerous transactions are affected when, from a tax treatment perspective, when they are conducted between connected persons. There are specific ways that those transactions are then treated or specific values that are placed on those transactions. And now what often happens with these limited partnerships is that you have large corporates that are silent partners investing into these partnerships. And because of the wide nature and web of this connected persons definition, you could have the bizarre scenario where, for example, a Naspers, which invests into a limited partnership, becomes connected to the Bank of America, who happens to be invested in a totally different limited partnership. And that could have severe implications for Naspers, as an example. I'm just talking hypothetically, but it could extend that wide. So the amendment is aimed to narrow the definition so that limited partners do not fall into the second part of that connected person definition to limit those bizarre scenarios from occurring. We welcome that amendment, of course, and the effective date for that would be applicable for years of assessment commencing on or after 1 Jan 2025. If we can go to our next topic, please, Sibu. Okay, so the next one deals with section 23N, cap N. And before I delve into the detail, I want to just spend a moment on explaining the background to section 23N. Otherwise, you might get lost, and I include myself in that. So by way of background, when a taxpayer borrows money to buy shares in a company, the interest that the taxpayer incurs on those funds used to buy the shares are generally doesn't qualify for tax deduction. And the reason for that is that shares can generally only produce exempt dividend income, and exempt income doesn't meet the definition of or at least the in production of income requirement for deductibility. And often transactions are structured in such a way by a willing seller looking to sell a business, that it is sold within a company, which means that the buyer is, I wouldn't say forced, but left with the only option of buying the shares in the company, although he is actually looking to buy the business in the underlying company. Now, that could be, very detrimental for the buyer if he couldn't get any tax deduction on the interest, on funding used to buy those shares. So in the past, and it's probably about 10 years ago, taxpayers came up, as they do, with weird and wonderful ways of recharacterizing debt in such scenarios, that it would be seen as debt used to acquire an operating business. And typically taxpayers would use the likes of Section 45 and Section 47, which are tax rollover relief provisions for moving businesses to get to that desired outcome. When the legislature became aware of this, in typical fashion, there was a knee-jerk reaction by banning the use of sections 45 and 47 for a period of time. But after a while, everyone came to their senses and decided to follow a more pragmatic approach and introduce section 23 cap N as well as section 24 cap O. The combination of those sections allow a person in certain instances to deduct interest incurred on funding used to acquire shares. And those shares are also qualifying shares, and it typically needs to be a controlling interest in a company which is an operating company. That was quite a long story, but what it boils down to in terms of this definition is that Section 23N, aims to limit the amount of interest you can deduct in such a scenario. The legislature wants to see a not too heavily geared scenario in terms of funding, and the formula in Section 23N aims to limit the interest deduction on a fairly geared scenario. So recently, Section 23M, which is the sister section and which seeks to limit the interest deduction on funds from persons who are not taxpayers in South Africa to also try and prevent profit erosion from South Africa, has received an overall and has been severely limited to a degree in terms of what interest deductions can be made. So Section 23N will be aligned to 23M, and it will result in a lesser deduction of interest allowable on those transactions going forward. So just by way of sort of putting it into context, at the current repo rate, and this is after last week's very generous 0.25% reduction in our repo rate, with the current formula, a taxpayer could end up claiming up to 41% of the adjusted taxable income, and that 41% will be replaced by 30%. Going forward, and that's from 1 Jan 2027. So not good news, but yeah, that's just one of those things, I guess. If we then move on to the next topic, please. So for those of you who attended our tax update session 2 years ago, and you may recall that we dealt with the assessed loss limitation rule. So for those of you who don't know or may have forgotten, there's a new rule that came in, and coupled with the reduction in the corporate tax rate from 28 to 27%, that says that where a company has an assessed loss carried forward, it can't necessarily set off that full assessed loss against a current year's taxable income. The assessed loss is rather limited to the greater of 1 million rand or 80% of the taxable income for that year before bringing in the assessed loss. The idea, of course, with that is to bring more cash into the fiscus quicker. The assessed loss itself is not lost. It still carries forward at its full quantum, but it would just take longer to utilize the full assessed loss. That's in a perfect scenario, but we of course have scenarios where companies look to liquidate, deregister, or wind up. And what often then happens with this new rule is that a company is not afforded the ability to utilize that full assessed loss. So what SARS is, or not SARS, the legislature is proposing is the relaxation of the assessed loss restriction rule. And for those appreciating the irony of the words relaxing and restriction in the same sentence, this is exactly how SARS put it in the explanatory memorandum. But it will then allow a company that is in the process of terminating its corporate existence to utilize its full assessed loss before it comes to its demise. So to also make sure that companies are honest and that they are in fact looking to end their corporate existence, the legislation brings this proposal in line with the Section 41 concept of a liquidation, deregistration and winding up. And that section contains specific requirements and steps to be taken to unwind or end the corporate existence. And there's also a specific timeline to that. To ensure that that is in fact the intention. And that'll come into effect from 2025 calendar year. Okay, then we can move on to our second of last topic that I will be dealing with. And this one deals with REITs, which is one of my personal favorites. Just to make sure we're all up to speed, a REIT is an abbreviation for a real estate investment trust. It's a defined concept in our Act, and it is at the moment, it is a company that is listed on a recognized stock exchange, such as the JSE, of course. It's limited to significant property companies that qualify with the JSE regulations to be regarded as a REIT. Now, the biggest selling point with being a REIT is that it enjoys a capital gains tax exemption on immovable property assets, which is a great benefit. And the idea with the REIT is also to try and mirror a direct property investment for the shareholder. And that mechanism is achieved partly with the CGT exemption, which means that the CGT for the shareholder is effectively deferred until the shareholder sells its shares in the REIT, and not every time the REIT sells a property. The mechanism also allows for a flow through of rental profits on an annual basis at a high level to the shareholder. And those dividends that flow through come through as taxable dividends in the hands of the shareholder and in fact enjoy a deduction in the hands of the REIT. So all things being equal and barring any abnormal type of transactions, a REIT can end up not paying any tax in any given year, with that tax effectively being shifted to the shareholders. So quite a nice mechanism for many investors. And unfortunately, at the moment, this regime has been limited to listed companies, of which currently there are 34 in South Africa. But the amendment that is contained in the current bill is that this will be extended at some point in time to unlisted properties, property companies. It will still be fairly regulated, and it seems at this point that the FSCA will look after those regulations. We anticipate that the requirements would be similar to that of a listed REIT, which currently requires the property company to own properties with a gross value of at least 300 million rand. And then it also can't be too heavily geared. Its debt levels can't exceed 60% of that asset value. It also needs to produce a high level of rental income. So if there are any of you out there with a sizable unlisted property portfolio earning rental income, and you are looking to get rid of that annoying deferred CGT liability dragging down the fair value adjustment on your property, perhaps this would be the way to go. And if you want to do so, who better to ask than BDO for some assistance on that. Then on to my last topic. Okay, and that's looking at an incentive. You can jump to the next slide, Sibo, please. Let's go 2 up. One down. So I think we need to be on. We need to move up a bit, please. Before international tax, we should be on this slide dealing with. That's the one. Thank you. All right, so the bill proposes the introduction of Section 12 Cap V, which is an investment allowance for the production of electric and hydrogen-powered vehicles. So, of course, as many of you will know, internationally, this is a big trend. There's a need to get rid of our carbon-emitting internal combustion engine vehicles. Which comes with a certain enjoyment factor, but we have to look after the planet, of course. And internationally, a lot of governments are incentivizing car manufacturers to start producing more and more of these cleaner vehicles, electric and hydrogen-powered vehicles. And of course, if South Africa, which is quite a player in the vehicle production market worldwide, does not follow suit, we would become uncompetitive. So the legislature is looking to introduce an investment incentive, investment into physical assets that could produce these vehicles. So the incentive is aimed at the costs incurred to buy any buildings or construct buildings and movable assets that will mainly be used for the manufacture of these cleaner vehicles. And the allowance is a once-off 150% of the cost incurred on those qualifying assets allowance. So the full cost plus an additional bonus 50%, if we can call it that. The requirements are that the assets must be used by the taxpayer or brought into use before you can claim the allowance. It must be new and unused assets or improvements or additions to those assets. And the assets must be owned by the taxpayer or at least acquired in terms of an installment sale agreement. Of course, where we get a bonus allowance, there would also be a penalty if this is misused, and therefore there's a special recoupment provision that will recoup that 50% additional allowance if that asset is no longer used for that purpose or if disposed of within a 5-year period. This will come into effect from 1 March 2026 and will currently apply for a 10-year window period. So as I mentioned, this section will carry the naming of 12 Cap V, and members of the audience may at this point be forgiven for thinking that the legislature had a sense of humor, but no, the 12D does not denote the voltage used by our carbon emitting vehicles. It is simply following the current section 12U in the 12 sequence incentive allowance section. So, but now that I've brought you up to speed with your ABCs, it's time for me to hand over to my esteemed colleague, Hilton Cameron. Thank you. Hilton, you're on mute.
Sorry about that. I'll just start again. So good morning, everyone. I'm going to be talking about a few international tax issues, and then I'm going to come back and talk about the coronation case after some of the other presenters. So if we can just go to the first slide, please. So this is an interesting one in terms of foreign claiming credits for your foreign taxes on respect of capital gains. So maybe we can just first of all look at Section 6 Quat. So Section 6 Quat allows the taxpayer to claim a credit, or what is technically a rebate of your foreign taxes paid in respect of your foreign income. You can also sometimes in certain scenarios claim a deduction. The problem with section 6 quat is it starts off on the face of it being pretty simple and then gets can get very complicated. And just to understand how complicated it can get, SARS issued interpretation note 18, which is already on their 5th version and is now going to be, it's a little bit late or a little bit dated. And that interpretation note 18 is 135 pages long. So that just gives you an idea of how complicated section 6 quat can be. So in terms of this actual amendment, we can say thank you to SARS because they've actually been quite kind and they have increased the potential capital gains credit that we can claim. The actual amendment, while it sounds that nice, is not normally, it doesn't come up that often. The main issue is normally a South African entity company usually owns foreign shares and doesn't that often own foreign capital assets. And if we own foreign shares, the issue is normally taken care of in terms of paragraph 64B, which often says any gain or loss on those disposal of those foreign shares is not taxable in South Africa. So we don't have to worry about foreign credits. But let's come back to the current capital gains tax amendment. So basically the problem is, in terms of our legislation, is the capital gain that is now included in income that is going to be taxed is basically 40% of that gain or 80% of that gain is then taxed in terms of South African tax law. And the problem with that is, if we look at the foreign tax law, often foreign tax laws don't have specific, they may have specific rules for how to work out a capital gain, but there's no 40% or 80% exclusion, which can mean the foreign tax that you have to pay is more than the South African tax if we work out the South African tax and the potential credit. So what's the amendment proposes, and for some reason it's slightly delayed to 1 January, but at least it's there, is basically instead of looking at that 40% or 80% cutoff, the full credit of 100% will be taken into account. So basically there was a potential for some of the credit to be lost, and this amendment allows the full credit to be allowed and potentially to be carried forward for up to 7 years. And just to understand sort of the complexity, in order to actually understand the amendment, what you need to do is you need to read section 6 quat 1, and then you need to read that with section 6 quat 1a, and then you must take into account the proviso, which is IIBB, which is the actual amendment, and plus you need to understand section 6 quat 1ba and potentially the proviso in terms of IB. So you need to read that, and then you read it again and read it the 3rd time, and you still probably are a little bit lost, and then maybe go to interpretation note 18 to have some further guidance. So that's just the issue on that one, the capital gains. So in all, we're happy with what SARS is doing. They are delaying the amendment, which is fine, but it's a recommended change. We are happy with it, although it doesn't come into effect that often. If we can go to the next slide, please. So the next one, which is something which I think is even more rare than the current, than the previous slide, is the treatment of foreign exchange gains and losses. And what SARS is concerned about is we have cross-currency swaps where we lend funds to probably our subsidiary, and at the same time we provide preference shares, and those preference shares are basically like a loan. So what SARS is concerned about is we have gains or losses on the potential loan, but we don't have gains or losses on any preference shares. So what SARS, the current amendment, is to include any gains or losses on preference shares, and those gains or losses on preference shares will now be included in the income of the taxpayer. But however, this only apply where that preference share is with a foreign company. So I haven't seen this too much in practice. In fact, I can't say I've seen it at all. But obviously, some people are doing it, and I assume they've got some, I don't know, high heads up and been able to calculate what they think are going to be the gains and losses going one way or the other, and making some nice gains and not taking into account, or they're making some nice losses and to their benefit. One of the downsides to me of the legislation is if we have a normal loan with a subsidiary, an offshore subsidiary, what section 24I10A does in certain scenarios, it can defer any gain or loss. So the current amendment doesn't allow such deferral, but there have been requests to allow that deferral if you meet those requirements in terms of section 24I10A. So basically the takeaway from this is if you are having preference shares in a non-resident subsidiary, then be aware that you are going to have exchange gains and losses on those preference shares. If we can have the next slide, please. So we come to this one, which is a, I don't know if the word is anomaly, but normally what happens in terms of your assessed losses, you can set off your assessed losses against your gains, and those get carried forward. There are sort of limitations which Louis mentioned, but the main issue here is your Section 24I gains and losses. So the issue with 24I gains and losses, it doesn't actually matter whether you are trading or not trading. You can have a gain or loss on your Section 24I instruments. And the main issue here is for companies which are dormant. However, while they are dormant, they can have foreign exchange gains and losses. So what happens in this scenario is there can be a foreign exchange gain, which the taxpayer is then taxed on, and then in a subsequent year there is a taxpayer loss, which they're obviously not taxed on, and this in the third year there's a gain again. So the problem is the gain, which is normally carried forward under normal scenarios, say the loss in year 2, which is normally carried forward in normal scenarios, is not carried forward for Section 24I. And the person will have a gain in year 1, a loss in year 2, and a gain in year 3. Whereas what should be allowed is a gain in year 1, loss in year 2, and then year 3 you set off that loss from your previous gain in year 2. So basically, this amendment, which is to be welcomed, is going to allow that gain from your say the loss in my example in year 2 will be allowed to be set off against your gain in year 3. So we welcome the amendment. Again, this is only effective on after 1 January 2025. So those who already have dormant companies which are making exchange gains and losses, the amendment is not applicable to you, but will be assistance going forward. There is a slight problem on the wording of the amendment, just to give people a heads up, and it arguably only applies to foreign currency option contracts. But clearly the wording in terms of the explanatory memorandum is meant to apply to all foreign exchange gains and losses and not just option contracts. And hopefully when the final act is enacted, they'll just correct that small, well, what we hope is a legislative mistake. I think that's it for me for now. Next up is, I think it's Cliff.
Thank you, Hilton, and good morning, everyone. I'm going to deal with the most important VAT amendments or proposed amendments, and yeah, just going to do the ones that are more applicable to a bigger audience. Next slide, please. The first amendment is in terms of the electronic services regime. Currently, all electronic services suppliers need to register and account for VAT on the electronic services that they supply to recipients in South Africa. It doesn't matter if it's a business to business or a business to consumer supply, they need to account. But this is not in line with global trends. So what Treasury is now trying to propose is it also to exclude the business to business transactions, because it makes sense that that foreign supplier needs to register and account for output tax on their supplies, but the recipient is a VAT registered entity that will just be able to claim the input tax. So there's actually no benefit to the fiscus except for the amount of VAT registrations and returns that they need to then manage and deal with. So what the proposal intend is to exclude persons that supply solely to vendors. Now, this is where the issue comes in, is that would it only apply to vendors that solely supply to vendors? But what if they supply to consumers and to vendors? Are they now excluded from this this proposal, or is it only the business to business transactions that are excluded? So one of the things is that it is not an amendment in the VAT Act, but it's a regulation that's still to be issued. So we are waiting for that regulation just to see if they provided clarity on that point. Then also there's a proposal that an intermediary in South Africa can also act on behalf of vendors. Now, previously, intermediaries could only act on behalf of persons that are not VAT registered vendors. But in certain instances, you can get a vendor that has other supplies and not just the electronic services. So they are registered for VAT in terms of those other supplies. But now the proposed amendment is that the intermediary can now also act on behalf of those VAT registered vendors in terms of the electronic services supplies. Then also a proposal that we welcome, and we look forward to see what they actually provide to us, is to provide clarity on minimal human interaction. So the main thing about electronic services or digital tax or whatever that it's called globally is that it is supplies that are automated. It is where there's no human intervention at all. So the regulation mentioned that it excludes services with minimal human intervention. So that wasn't defined. So we just need to see what the clarity is that they will provide. If we can move on to the next slide, please. Yeah, this is a proposal for non-resident lessors of ships, aircrafts, and rolling stock, as well as the parts required for those ships, aircraft, and rolling stock. There was an amendment in January 2023 where those lessors are excluded from the definition of enterprise. Now, the requirement to be excluded was that the recipient would be responsible for importing those goods into South Africa, and that the recipient would claim the VAT on importation, and that the supplier is or the recipient is not reimbursed by the supplier for the VAT that they've incurred. And that agreement must be in writing in order to be excluded. Now, the consequence of that is that because they're now excluded from the definition of enterprise, is that they need to deregister for VAT. And one of the consequences of deregistering for VAT is that Section 8.2 now has this output tax deemed supply, where the vendor now needs to account for output tax on the assets that are still left in the business. But because the vendor could never claim the input tax because of the requirement, the proposal is now to amend Section 8.2 to exclude these specific scenarios for these lessors. Now, what's important is that the effective date is 1 January 2023. So it's backdated, and that's one thing that we don't normally see, where a proposal is actually backdated, but that is when the those vendors were required to deregister from that. If we can move on to the next slide, please. Okay, this is like an unintended consequence. If one look at the provision of Section 11.2L, where it says that services are supplied to a non-resident can be zero rated. But if you look at it says a person that is not a resident of the Republic. Now, the definition of resident of the Republic includes a resident as per the Income Tax Act. Now, the Income Tax Act includes that if a person has a place of effective management in South Africa, that they are resident. Now, in certain instances, it is say a holding company supplying services to its subsidiary registered outside South Africa, but now because of the effective place of or place of effective management is in South Africa, that section 11(2)(l) cannot apply because it's applied to a resident as per the Income Tax Act. So that has been an issue, and the new proposal is now to exclude from the definition of resident of the Republic that if the person is a resident solely because of its place of effective management that is in South Africa, that the zero rate can then apply, because it's not the person is then deemed to be a resident of the Republic. The effective date there is on the 1st of January 2025. If we can go to the next slide, please. This is on the proposal for the foreign donor funded projects. In April 2020, the Act was amended to force implementing agents in South Africa to register a separate branch of its main business. So it's already registered for VAT, so it needed to register a separate VAT registration for each branch, for each foreign donor funded project that it manages. So in some instances, these some implementing agents would manage like numerous foreign donor funded projects, and this required them to now submit VAT returns for all of these projects that they manage. So that created quite a significant admin burden for those implementing agents, and that's the reason for the proposal that these implementing agents can now register one separate branch for all the foreign donor funded projects that they manage. Now, there are quite a few requirements. In the first instance, that the implementing agent must keep an independent system of accounting for each project, that it must also keep reconciliations of all amounts for all the relevant foreign donor funded projects, and then each project must still be approved by the Minister of Finance as a foreign donor funded project. Now, I'm not sure if they achieved the objective of relieving the administrative burden because of all these requirements still, but yeah, obviously it is just one VAT return and not separate VAT returns. And the effective date is the 1st of January 2025. Can move on to the next slide, please. Now, what's important here is that this proposal is not included in the amendments, and we're quite happy about that. But it revolves around educational services that are supplied by educational institutions to third parties, or supplies by educational institutions to third parties. Now, if one reads the definition of section 12H, there could be, or there are definitely different interpretations. In the one instance, it says the interpretation is that if the supplies are mainly, which is more than 50%, for the benefit of the learners, then all the supplies are then exempt. But if one also reads that one of the requirements is that the consideration must be in the form of school fees, tuition fees, board or lodging. So if the consideration is not one of those, is that now excluded from educational services? Now, if one can just look at the scenario in South Africa, that most schools need to bolster their revenues, and they have all these separate supplies that they are also making, where they rent out some of their facilities to third parties for additional revenue. Now, is that now exempt, or is it standard rated because it's not in the form of school fees, tuition fees, board or lodging? Now, the proposal was that any services that are necessary for, subordinate or incidental to the educational services are exempt, which could be interpreted that anything that are incidental to the school's supplies of educational services are then also exempt. Now, also the proposal was that if the school got it, or the university or the educational institution got it wrong, that SARS could not raise any assessments. Now, the big issue here is that if now suddenly the school had the educational services that were exempt, and they now had all these other supplies that they now deemed to be standard rated, like the renting of facilities, that they could now claim additional input tax because of the apportionment ratio, because they made taxable supplies. Now, if the interpretation now is that all supplies are now exempt from that, they need to deregister for that, or if they still do have taxable supplies, that the taxable supplies are going to be significantly less, and this would either have a deregistration requirement, and then there's a Section 82 output tax liability on deregistration, or if it's a significant reduction in the taxable supplies, that there could be huge Section 18 adjustments that need to be made. And I don't know where those educational institutions are going to get that money from to make those output tax adjustments or account for the output tax. But we'll wait and see when the amendment actually comes through, because yeah, if SARS is something on their radar, they tend to stick to that. Okay, next slide, please. This is also something that wasn't promulgated, and that's the prescription period for input tax claims. Now, currently, or generally, there's this prescription period of 5 years. So if you haven't claimed an input tax deduction, you've got a 5-year period from the time of supply to claim the input tax. Now, SARS, the risk is, and this is where my issue is that I think it's more from a SARS audit perspective than from a legislative perspective, because SARS was, the risk was that there could be double claims, or that a vendor can claim something in a current tax period that is more than 5 years, extending the 5-year prescription period, and then just slipping it into a current VAT return without SARS noticing, even if there's a verification audit, that SARS wouldn't pick it up. Now, the proposal was that input tax, if you did not claim the input tax in the original tax period, that you must now reopen that specific tax period and claim the input tax in that period only. You can't claim it in a subsequent period. Now, I don't think SARS actually considered the system problems, because if a VAT period, a tax period, has been subject to a verification and that verification has been closed, there's no way that you can reopen that tax period. So I'm not sure how you can claim an input tax in that period. And then also, SARS' system doesn't allow you to increase input tax. So again, they must then include this if they want to go ahead with that. But I mean, SAICA, SITE, and industry in general made several submissions to National Treasury and SARS to say, please, this won't work. So luckily they've withdrawn the proposal. But again, what's coming? If it's on their radar, they will think about other ways of limiting that. We're now going to carry on with the next topic on the Tax Administration Act proposals. So if you can just go into the next slide, I'm going to do the first one. Next slide, please. Okay, the first one is the VAT on imported services. There was an issue that it was impractical to pay the VAT on imported services within the 30-day time frame that was included in the VAT Act. So the 30-day period starts from the date of the invoice from either the foreign supplier, or if it's self-invoicing, from the recipient, or any payment received, whichever is the earlier. Now, the proposal is to extend that to 60 days. Now, what's important here is that if it's a registered vendor that has to account for VAT on imported services, which means they acquired the goods for non-taxable purposes, either exempt or non-taxable purposes, that they account for that on the VAT return. So that period is further extended depending on whether it's a monthly or bi-monthly VAT return. So yeah, it is only need to account for it when the VAT return is due. Then the second one is the VAT Act currently does not have any provisions for if there's an overpayment of customs VAT on importation, when importation of goods, or the VAT on imported services, if there's an overpayment to reclaim that. So the amendment is just to, in terms of section 16, just to allow for an input tax deduction for that overpayment of the customs VAT or VAT on importation. Then the last one is just currently electronic services suppliers do not need a VAT representative vendor that's a resident of the Republic or a bank account in the Republic or with a South African registered bank, because they are not present in South Africa at all. But the proposal is now to also amend section 23 to exclude certain persons. I'm talking about a person which could be a natural person or a company that has got limited to no presence in South Africa, to also not have a VAT representative vendor that's a resident or a bank account in South Africa. And I'm now going to hand over to David just to continue with the other Tax Administration Act proposals.
Thanks, Cliff. Yeah, this amendment is one that gets some taxpayers hot under the collar because it doesn't seem to be very even-handed. So what this is saying is that the cost of a senior SARS official involved in a tax dispute, which is going to then have to be a legal practitioner, will be recoverable by SARS in disputes with taxpayers, and presumably those cost orders will go SARS's way if SARS wins the case. And that those internal costs of those senior SARS officials will then be recoverable in the same manner as if the functions had been performed by a legal practitioner in private practice. So to be even-handed, it should then be that if a taxpayer wins a case and they've used their own internal legal counsel in the High Court or the Supreme Court or the Constitutional Court, that they should then also be able to recover the costs from SARS. But the proposal, unfortunately, is not worded in that manner. So the courts that we're talking about here that are directly affected by Section 12 itself are the costs in the High Court, the Supreme Court, or the Constitutional Court. Rather cryptically, there's also a proposed change to Section 130 of the Tax Administration Act that seems to imply that SARS is seeking to extend the same treatment to the tax court, to its costs in the tax court. But the dispute resolution rules would need to be amended for that. And so we await changes to the dispute resolution rules in that regard. Sibo, if you could move on to the next slide, please. Thanks. Okay, so this one deals with the dispute resolution process and may be advantageous. It remains to be seen. But if we just consider the life of a typical dispute, what usually happens is that it starts off with an assessment or an additional assessment that's raised by SARS that the taxpayer doesn't agree with, and the taxpayer then lodges an objection to that assessment. SARS may allow the objection, in whole or in part. If the taxpayer is still dissatisfied, then they lodge an appeal. And it's at the appeal stage currently where this alternative dispute resolution process may be opted into. And it's usually opted into by taxpayers, not always, but mostly. And SARS usually opts into it. Either party can opt out of it, in which case the matter goes straight to either the tax board or the tax court. It's a non-binding process, so either party, if they're dissatisfied with the way things are going, can opt out of it at any stage of the ADR and then go to the tax board or the tax court from there. But practically, SARS has found that the majority of the disputes are settled in the alternative dispute resolution process. So the idea is to drop the whole process down a level and introduce it at the objection phase, probably also at the appeal phase, as is currently the case, but also introduce it lower down or earlier on, shall I say, in the objection phase, which would supposedly allow for an earlier resolution. It will necessitate changes to the current dispute resolution rules, which will then need to be made and then circulated. And it's not clear that SARS's processes currently allow for this either. So it might take a little while before we see this come in. And then I think we'll also see those proposed changes to the dispute resolution commented on and the comments hopefully taken into account before the proposal comes into effect. Thanks, Sibo. If we can move on. Okay, so I'm going to have more to say about representative taxpayers such as a public officer when we look at the Visa case later on. But just note for now that this change is removing the 1 month deadline that currently exists for appointing a public officer, and that 30 days is from the date on which a company commences its operations in South Africa, that it has to appoint a public officer currently. And instead of that, what's going to happen is that the company still has an obligation to appoint a public officer in terms of Section 246. But if it fails to do so, then there's going to be an order of priority that's going to apply, a deemed order, and it's going to then be deemed that, starting with that list, the managing director, or failing that person, the financial director, etc., working down the list, are going to then be deemed to be the public officer of the company. SARS has also got the discretion to appoint a person as the public officer. But it's quite an onerous requirement, being a public officer, as we're going to see later on when we discuss the Visa case. So not to be undertaken lightly. And now just note that there's going to be a deemed public officer appointed if one hasn't actually been appointed by the company or by SARS. Thanks. If we could go on, Sibu. This amendment of Section 125 seeks to give effect to the Poulter judgment, which was a decision of the Western Cape High Court, where Judge Binsward held essentially that that a layperson is allowed to represent a taxpayer in proceedings in the tax court. So the background to that Poulter matter was that Mr. Gary van der Merwe sought to represent his daughter Candice, whose married name is now Poulter, in the tax court, and the tax court refused that representation, and then he therefore appealed on to that decision of the tax court to the Western Cape High Court that ruled in his favor. So the proposed amendment will now expressly allow a natural person whose other than a duly admitted legal practitioner to represent a taxpayer in the tax court. This always used to be the position, by the way, expressly as well in Section 125, before there was a deletion of Section 125.2 back in 2017, and then it became unclear what the position really was. So this is sort of reinstating that position, but with a bit of a difference. So it's saying that the representation will be permitted if the person's not a legal practitioner, if the president of the tax court deems the representative to be a fit and proper person to appear on the taxpayer's behalf. And it's not 100% clear how this fit and proper is going to be interpreted by the judges who are the presidents of the tax court, and that remains to be seen. Okay, I hand over now to Hilton, who's going to take us through the coronation decision.
Thanks, David. So the first case, as David said, is the coronation court case. So let's just go to a bit of background. What the coronation court case deals with is Section 9D. So what Section 9D does is it looks at your controlled foreign companies, which is basically a company in which South African tax residents own more than 50% of. So the issue being is, let's just use a simple example of if you own 100% of a subsidiary, and that subsidiary is a foreign company, that foreign company is called a controlled foreign company. And then what can happen in terms of Section 9D is the income of that controlled foreign company can be attributed to the South African shareholder. And just to be clear, some people think the income is only attributed to, say, when a dividend gets paid back, or maybe there's a service fee paid back to South Africa. That's not the case. The issue is, even if nothing is paid back to South Africa, in terms of Section 9D, the income, or what we call the net income, can be attributed back to the South African shareholder. So the two mechanisms, or well, it's three, of stopping that attribution is one, if the CFC is actually making losses, and that's losses in terms of South African tax rules, not in terms of the foreign tax rules. And then the main exemptions, though, are if the so-called high tax exemption, which is not applicable in this case. The other alternative exemption is the foreign business establishment exemption, which basically looks at, do you have substance in that foreign company, in that foreign country? So if you have substance in that foreign country and you've got a real operating business, then generally the law will state that that income is going to be taxed in that foreign country and there's no attribution back to South Africa. Unfortunately, there are various exceptions to the foreign business establishment exclusion, but those are not really applicable in the current matter. So just to carry on about this case, what happened in this case is Coronation had a subsidiary. It was an indirect subsidiary, but they held 100% indirectly. And effectively what happened is SARS attacked the company and said there was no foreign business establishment, and I'll get to that in more detail later. And because there was no foreign business establishment, the entire net income of that company was taxed in the South African shareholders' hands. And according to call it the newspaper reports, anywhere between 750 million to 800 million was going to be included in the income of Coronation. And if I remember correctly, when the Supreme Court of Appeal decision came out, the actual share price went down a little bit. So the takeaway is a lot of people have controlled foreign companies, and I sort of deal with these on almost a daily basis, and sometimes they are just ignored. Other times they're looked at in more detail. The important issue is if you have a controlled foreign company, you need to be aware of what's going on there and need to check if any income is going to be taxed in the SA shareholders' hands. So if we can go to the first page. So maybe I'll just give a bit of initial background, or further background. Is what happened is the taxpayer Coronation, they won in the tax court, then they lost in the Supreme Court of Appeal, and bear in mind that was the 5 judges who all unanimously ruled that they lost, and then in the Constitutional Court all 9 judges ruled against SARS, and Coronation won. But we'll go through that slowly. So we just come to the facts of the matter. So this actually went all the way back to 2012. And just to understand how long things have gone, is that the Constitutional Court finally decided the matter, I think it was in June of this year. So just over 12 years from year of assessment to get the matter finally settled. So as I said, CIMSA, which is the Coronation company, that was a tax resident in South Africa, and it held a subsidiary which was a tax resident and was incorporated in Ireland, CGFM. So what happened with CGFM, they had a fund management license. So that was the big issue, is what does this fund management license do? But we'll get to more detail about that. So basically CGFM received a whole lot of funds, and then if I just put it simply, is those funds were invested. Obviously the funds, people sell the funds, invest the funds, make gains or losses on those funds, and then the investors get a return. What happened in this scenario is CGFM elected to outsource the investment management services, or what we can call the investment trading services, to a UK company and to a South African company, which were part of the same group as CIMSA. And then, as I said, SARS was of the view that the primary operations of CGFM were investment management, and those investment services were conducted by South Africa and in the UK, and thus the requirements for the foreign business establishment were not met. If we can move to the next slide. So the important issue here is, in terms of section 9B, is we look at the foreign business establishment. So what do we need in order to have a foreign business establishment? So as I said earlier, in order to have a foreign business establishment, generally what you need is a operating company which has people, it has equipment, and it has an office. But in this scenario, our office, we had an office, we had people, we had 4 people though, and those 4 people, as if the newspapers can be believed, were generating up to 750 million. So you can imagine SARS were looking at this saying, these 4 people are generating 750 million, something's not right. The foreign business is not really being conducted by these people, it's being conducted by somebody else. But we come back to the actual definition. So the first part is point 1, is a fixed place of business. So the issue is what is the business of this company? And then the rest of the requirements are pretty clear. But then in 4 and 5 and 6 is we need to have on-site managerial operational employees who conduct the primary operations of that business. And then 5 is must be suitably equipped to conduct the primary operation. And 6 is have suitable facilities to conduct the primary operations. So the issue is, what is the fixed place of business? And then do we have staff and do we have the facilities to conduct the primary operations? And those are sort of quite interrelated. If we can go to the next slide, please. Then there is a proviso which does state that the control foreign company, in order to make sure that it has the staff and equipment, it can make use of another CFC if that CFC is in the same jurisdiction as, in this case, Ireland. It forms part of the same group and are located in the same country. So what SARS was saying is this proviso does not apply, because while you are making use of staff and equipment of another company, that company is in South Africa and is in the UK, so you cannot use that proviso. If we can go to the next slide, please. So what happened, as I said, in the tax court, the taxpayer won. The court holding that the company provided funds management activities, and those met the definition of a foreign business establishment. So as I said, we got to the Supreme Court of Appeal, and this was in, I think it was February 2023, where the Supreme Court of Appeal issued its decision, and a lot of taxpayers were very, let's just say, I don't know, some were scared, some were upset, but certainly Coronation would have been upset because the Supreme Court of Appeal ruled in favor of SARS. And what happened in the court, they found the primary operations of this company to be investment management, and those investment management activities were outsourced, and therefore there were no staff or facilities to conduct that primary operations. So in essence, the FBE requirements were not met. They then looked at the net income. As I said, the reports are anywhere between 750 to 800 million. It's not clear if they would have actually taken into account 2013 or later years, but the structure was unwound in any event. But the important issue was the whole lot of amount is now going to be taxed. One of the issues which was also discussed, which to me is fairly important in the Supreme Court of Appeal, was the issue for understatement penalties. So SARS levied a 10% underestimate penalty, and what the Supreme Court of Appeal held was that there was a bona fide inadvertent error, and due to that bona fide inadvertent error, the 10% was reduced to naught. So just to come back to why the Supreme Court of Appeal stated that it was a bona fide inadvertent error, they said that they had a tax opinion, which interestingly enough, the taxpayer did not actually disclose. It was not clear why they did not disclose it, but they said they had a tax opinion which ruled in their favor. Plus they were audited and their tax returns were done by another firm. So in terms of the audit, the tax returns being done by another firm, and plus the opinion, the court ruled that there was a bona fide inadvertent error, so there were no penalties. Interestingly enough, we've just dealt with a recent matter where SARS basically was saying, so what we said in a recent matter is, in terms of the Coronation Court, there is a bona fide inadvertent error there and there's no tax, where SARS was kind of, they didn't say it they didn't overtly say it, but basically what they sort of hinted at was, because this matter has not been heard in the Constitutional Court, that there is no the bona fide inadvertent error excuse cannot apply. In our view, it was certainly heard in the Supreme Court of Appeal. The Supreme Court of Appeal pronounces judgment. So to me, it's binding up to that level, which is the second highest court of the land. Just then to carry on is obviously, as I said, Coronation or CIMSA took leave to appeal to the Constitutional Court, and SARS took leave to appeal, and then they were appealing against the penalty issue as they wanted the 10% penalty to apply. So just in terms of the appeal, if we can go to the next slide, please. In order to appeal to the Constitutional Court, you need to state that there are arguable points of law which are important to the general public, and it must affect South African, it must be of general importance, and what CIMSA argued in terms of the appeal to the Constitutional Court, it affects all South African companies with CFCs. The issue being that if anyone is outsourcing any of their functions, which basically most CFCs will do to some degree, this issue needs to be clarified. In my mind, there's a bit of an issue with this, as previously we used to just look at whether a matter to court, the highest court in the land was the Supreme Court of Appeal. Obviously, the Constitutional Court came, but in my view, this was meant to do with Constitutional Court or constitutional issues as opposed to general tax legislation. So we now have an issue where previously the matter was finalized in the Supreme Court of Appeal, and basically, I think it was in 2021, the Constitutional Court said we can also hear tax matters. And now, as you've seen, there's been various tax matters which have gone to the Constitutional Court, which to me delays things. Fortunately, in this scenario, it made things better. But let's come back to the submissions that CIMSA was going to put forward. So what they said is CGF, the business of CGFM is that of fund management. CGF had not been granted a license to perform investment management trading activities. And basically those investment trading activities were outsourced to two other companies, as I said, in the UK and South Africa. So in terms of the FPE, their business is fund management, not investment management trading activities. They are not relying on the proviso, which, as I said, the proviso, we can look at other companies, but in the same country. So they said we are not looking at that. And obviously they could not look at that because they didn't actually have any other companies in the same country. So they specifically said they're not looking at. And another issue is the Supreme Court of Appeal kind of looked at what can this company do as opposed to what does it actually do. And Supreme Court of Appeal, so the CIMSA's argument was we don't actually look at anything that this company can do. We do actually look at what does the company do, and in terms of the license, what does the license state. So SARS's submission, obviously they're going to stick with their argument, which they won in Supreme Court of Appeal, is that its core functions are basically the management or trading activities, and those were outsourced to South Africa and the UK, and they still went on about the proviso, which clearly CIMSA says not even applicable. So if we can go to the next slide, please. What the Constitutional Court said, and again, it's quite, I'm not sure what the word is, but basically an anomaly, is that we have 5 judges unanimously deciding in favor of the SARS in the Supreme Court of Appeal, and then 9 judges in favor of the taxpayer in the Constitutional Court. So the core issue is, what is CGFM's business? And once we understand that, is, does the company have conduct its primary operations with the staff and the equipment? So if we can go to the next slide. So basically what the court says is we need to distinguish between investment management and investment trading functions. The license issued by the Central Bank of Ireland, and to me this was a very important issue, is there were 2 different, if I call it, factual findings on this point. The Supreme Court of Appeal said, in terms of the license, the company can do investment trading activities, whereas the Constitutional Court says the license did not allow the company to do investment trading activities. It could only do investment fund management activities or investment functions in a wider sense than investment trading activities. Then in terms of the evidence of the witnesses, those are basically uncontested. And to me, an important issue was the general operations, both in terms of South Africa and in Ireland, which certainly helped the taxpayer, is that this model of having, just say in this scenario, 4 people who are in tasks with the fund management, that is a general model which is followed in South Africa in terms of Coronation's own model, and it's followed in Ireland, and it's been followed by what the witnesses said, at least 80% of the companies in Ireland, where you have fund management and then the actual trading activities are outsourced to third parties. So it is we can call it a common practice, and certainly has not been done for any tax reason. So if we just take a step back right to the beginning of the case, and I haven't got this in the slides here, but what the judges looked at when Section 9D was initially enacted, and just for those of you who don't deal with Section 9D that often, is it was enacted in 2002. Well, it was before then, but sort of the version that we are now, it was in 2002, but there have been changes every year. So every single year there's been a change to Section 9D. But what the overall intention of SARS in terms of the enactment of Section 9D is, it says we are looking at 2 different issues here. We want South African companies to be competitive in an offshore market, and we also don't want South African companies just to simply set up companies outside South Africa to try and avoid tax. So there's 2 competing issues here. We need South African companies, and in this case, operating companies, to be competitive outside South Africa on a global market. And against that, we are also concerned about some people simply setting up controlled foreign companies to try and avoid South African tax. So if we can go to the next slide, please. The next slide, Sibo. Okay, so basically what the Constitutional Court said, and to me, what another interesting thing, so just go back one, I think we've gone 2. Maybe we can go back a slide. Okay, so thanks. So basically, if we're looking, to me, what was quite important was also, which shows, so no, going one ahead again. And two important issues is, which is, so just the next slide down. Okay, there we go. Okay, so if we just look at that second bullet, which to me was sometimes a little bit confusing, which may have also helped confuse SARS, is how CGFM earns its fees is based on the value of funds, which to me is a fund management activity, as opposed to the performance of investment trading activities. So CGFM, it simply gets fees based on the value of the funds, as opposed to how the performance of those investment trading activities, which would have been the funds earned by the South African company and the UK company. So what the court continues to say is, based on all these effective activities, is the fund, or CGFM, is a fund manager and not a investment trading manager. So therefore, as a fund manager, it was allowed to outsource its activities, and it had a foreign business establishment. if I've just highlighted the one point, to me, which is not so much in terms of tax law, but quite a nice ruling from the Constitutional Court. It says requiring a South African company to set up a foreign business establishment with this anti-competitive limitation is illogical. That's this anti-outsourcing and does not make business sense and undermines the object of Section 9D. It would inadvertently discourage legitimate business practices that contribute to the efficiency and the competitiveness of South African companies on a global stage. So basically, in summary, the court was saying, in terms of this particular example, you can outsource a significant part of the business, but that is not your actual business. What your business, and in this case, is fund management. And to me, what worked very nicely in their favor, as I said, this was a common business practice in terms of what was done in South Africa and was done in Ireland. And to try and say they cannot do this, the court was at pains to say, well, that's going to make South African companies uncompetitive, and this should not be the intention of Section 9D. So I'm sure Coronation is very happy, and a lot of other fund managers, because they have what we understand is they have similar models. They're very happy. Just an interesting issue is on to Section 9D. What happened, as I said, the Supreme Court of Appeal ruled in favor of SARS in February 2023. And then in terms of the amendments in July 2023, SARS basically enacted certain amendments which provided a similar result to what the Supreme Court of Appeal was wanting or stated and what SARS wanted. But basically, in terms of the advisors, we also said, no, the Supreme Court of Appeal has already advised, well, given a judgment in your favor. So no need to change Section 9D. So the revised, or not the revised, the Constitutional Court came out in June. So there certainly has been time for SARS to look at Section 9D and do possible amendments. But the latest draft of amendments, the latest bill, and even the earlier bills did not have any amendments to Section 9D in regard to the Coronation case, which is quite surprising. But perhaps it was because of that final point I was reading above, that the Constitutional Court was saying, if this is how you look at things, South Africa is going to be uncompetitive on a global stage. So maybe that's why we can only hope there have not been any amendments to Section 9D at this point. That's the end of Section 9D. So if we can go to, it's David, if we take it over.
Thanks, Hilton. Yeah, let's move on to the next case. There are two more cases to go. This next one is Christo Wiese and others versus SARS. Thanks, Sebo. Sebo, if you can move to the next slide, please. Presentation seems to be frozen on my side, Sebo. I presume you have moved on to slide 41. Okay, anyway, let me give you some of the background to this case while we're waiting for the slides to hopefully update. It was a Supreme Court of Appeal case, and basically SARS was seeking to hold Christo Wiese and other directors of a company which was called Energy Africa personally liable for the tax debt, which was significant tax debt of the underlying company in terms of Section 183 of the Tax Administration Act. And basically, the matter went all the way back to 2007, when the taxpayer, which was underlying taxpayer, was Energy Africa, this company that had sold its shares and claims in a subsidiary company to another company called Tullow Overseas Holdings. And basically what happened was, therefore, there was a capital gain. According to SARS, there was a capital gain anyway that wasn't disclosed in the taxpayer's 2007 income tax return. And then in 2012, SARS audited that transaction. So 5 years later, it audited those transactions, and it then notified Energy Africa that it intended to raise additional assessments for a total of about 1 billion rand altogether, for the inclusion of capital gains tax of about 450 million and STC of about 487 million, including severe penalties of 150%. So, yeah, thanks. It looks as if the slides are back. That's the right place. Thanks, Ibu. Visa then and the former directors disputed those audit findings on the 15th of April 2013. And then 4 days later, on the 19th of April 2013, and bear in mind, of course, that all these years had gone, 6 years had gone by from the original year of assessment, 2007 to 2013. And in that time, this company, Energy Africa, that was supposedly had the capital gain, its only asset now was actually a loan account in a subsidiary company. And those 4 days later, after they disputed the audit findings, Energy Africa then distributed a dividend in specie of that loan account up to its holding company. So then it was left with no assets. Thanks. Next slide, please, Sibyl. So then in 2013, August, SARS issued the additional assessments that were foreshadowed in the audit findings for capital gains and STC, and levied those understatement penalties. The taxpayer then objected. SARS reduced the penalties to 100 but dismissed the objections. Now, what's quite interesting to me here is that the taxpayer then chose not to appeal the disallowance of the objections. And I suppose they must have been quite confident that their defense would be that, well, SARS can pursue the company, but there's nothing in the company against which to claim. And that would be a steadfast sort of rock solid defense. Anyway, SARS was then informed that the company then was dormant. And then SARS initiated an inquiry in 2015, contending that Visa and the other directors had knowingly assisted the taxpayer to part with its sole asset with the intention of obstructing the collection of a tax debt. And in 2016, they sent notices of personal liability under the Section 183 to Visa and the former directors. And the appellants maintained that because the distribution of the dividend preceded the date of the issuance of the additional assessments, when the alleged dissipation of assets had happened, there wasn't a tax debt as defined that existed at the date of the distribution. So that Section 183 would be inapplicable. They then went off to contest the matter in the High Court. Thanks. Next slide, please. The High Court was required to decide two issues: whether, firstly, the transcript of evidence that was presented by the appellants at the inquiry was admissible in these subsequent proceedings, and if so, for what purpose? And secondly, this very interesting question, whether the STC and CGT amounts that had not been assessed at that stage constituted tax debts, although they hadn't been assessed. There on the slide, you've got Section 183. So let's just have a look at that section, because that was the section in terms of which SARS is seeking to apply against Visa and the other directors. It says, if a person knowingly assists in dissipating a taxpayer's assets in order to obstruct the collection of a tax debt of the taxpayer, the person is jointly and severally liable with the taxpayer for the tax debt to the extent that the person's assistance reduces the assets available to pay the taxpayer's tax debt. So you can see that there are various requirements there before the section can be applied. There's got to be a knowing assistance, firstly, and then it's got to be in order to obstruct the collection, and then this question of the tax debt. So what the High Court, and in fact later on the Supreme Court, were involved with is the question of deciding whether the tax debt existed at the time of the dissipation. The other issues about whether Visa and the other directors knowingly assisted, whether it was to obstruct the collection of the tax debt, that will still be decided. That hasn't been decided. So what we're seeing here isn't a full application of section or decision based on application of section 183. It was only on the separated issue of tax debt and the admissibility of the evidence. Next slide, please. Okay, so these two issues before the High Court. I'm more interested for our present discussion on this question about the tax debt. Just note that the High Court found that the transcript was admissible, but I'm more interested on this issue of the tax debt. The High Court also found that the indebtedness with STC and CGT existed prior to its subsequent assessment, and then the parties went off to the Supreme Court. So I think let's go on to the next slide, which is the issues before the Supreme Court, which were essentially the same issues that were before the High Court. And we'll have a look at what the Supreme Court had to say, particularly on the issue of the tax debt. And they held, by the way, that the transcript was in fact admissible. But on the question of the tax debt, whether that existed at the time of the dissipation, let's go on to the next slide. So these are the arguments of the appellants and SARS. And I think if you look at the arguments of the appellants, I think the term tax debt, if you asked most lay people and probably even tax practitioners what they believe, when does a tax debt exist? They'd probably say, well, when SARS assesses it. Okay, that would be usually, I suppose, a response. But that wasn't what, ultimately what the court found here, just giving you, foreshadowing what they actually said. And the appellants argued along those sort of lines. In order to establish liability under Section 183, the person must have knowingly assisted in order to obstruct the collection. A tax debt must necessarily have existed, and the person concerned must have known that the tax debt existed. A tax debt is an amount which is due and payable, as the ordinary meaning of the term suggests, and that a tax debt only arose upon issuance of a notice of assessment. No tax debt existed, in summary, at the time of the distribution of the dividend in specie. SARS, on the other hand, argued that Section 183 envisages a tax debt being due or payable. So it could be due but not yet payable, payable but not yet due, etc. It contemplates that which may become due. It is sufficient if at the time of dissipation of assets, a tax debt is anticipated. So let's move on to the next slide, which then deals with the SCA's findings. Thanks, Sibu. As I mentioned before, the finding was adverse to Visa and the other directors. How they got there was like this. They said, firstly, that Section 169 as worded refers to a tax debt due as being an amount due or payable, not and payable, so it's one or the other. And then they said that the assessment itself does not impose a liability for tax. The liability for tax is actually imposed through the operation of law, regardless of whether an assessment exists. What they said is basically that they're taxable events that give rise to the liability to pay tax to SARS. So, for example, in the case of capital gains tax, you have a disposal of an asset which is a taxable event, and that gives rise to a liability then and there, as it were, because it attaches to the transaction. The same thing with the declaration of a dividend that gives rise to dividends tax. Now, I mean, I do think that one has got to put some limit on that because, for example, yes, you might have a capital gain as a result of a disposal of an asset, but that amount doesn't then have to be paid to SARS because you might then have subsequent transactions that give rise to capital losses. So I think one has got to say that at the end of a year of assessment, that's when your liability by operation of law sort of is crystallized. And tax is an annual event, as we know from other case law and so forth, Caltex Oil and the like. So I think it's more correct to say at the end of the year of assessment rather than in each individual transaction that necessarily gives rise, certainly in the case of income tax. They quoted other decisions of the SCA in support of their position, the Namex case, the Singh case, which weren't exactly, I don't think, on the same point, but they did lend support to their finding. They said that the language of Section 183 construed within its context did not require that the taxpayer's liability should have been determined by assessment, the time of the dissipation of assets. And they said it would defeat the purpose of the section and create an absurdity to hold otherwise. So the thing is this, that they said if you interpreted that a tax debt necessarily requires an assessment before it can exist, then a culpable third party could easily escape Section 183 by dissipating assets, provided that no assessment had yet been raised, and that would circumvent what was intended by Section 183. And so they, in summary, held that tax debt was in existence at the time of dissipation, and even though assessments hadn't been issued, and that the High Court order was correct. Now, we haven't got time to go into all of it, but just go into the next slide, please, Sibu. As I mentioned earlier, there are going to be these other issues about whether it was a knowing assistance and whether the purpose or intent was to obstruct the collection of a tax debt, which will be doubtless the subject of subsequent litigation. But if you go on to then the next slide, what I did is this term tax debt, outstanding tax debt, tax payable, comes up in a number of other sections of the Tax Administration Act. And I've done a summary for you, which you'll get in the slides, where we look at various other sections where these terms are used. So I think the one in particular that is quite worrying is this issue of a representative taxpayer, which would include a public officer, is deemed to be the representative taxpayer for a company, for example. And they can be held personally liable. Thanks, Steve. What's the following slide? A representative taxpayer can be held personally liable for tax payable in their representative capacity if they alienate, charge, or dispose of amounts on which the tax is chargeable while it remains unpaid, or disposes of or parts with funds in their possession that could have been used to pay the tax. So it uses the term tax payable. And I think if you look at the intention of that section, that doesn't require an assessment to be issued. So, for example, it could apply to a second provisional tax payment that's not made by a representative taxpayer. And that could invoke that section. It doesn't require an assessment. So just remember what I said earlier about the public officers now being deemed to be persons, even if one hasn't been appointed. So I think this potentially could be quite a nasty section. And a lot of public officers, I don't think in any case, realize the import of that section. We have others, just very briefly, 169.2 talks about representative taxpayers, but it's less invasive in the sense that it only talks about the confiscation of assets belonging to the taxpayer that are in the possession of the representative taxpayer. Section 179 uses the term outstanding tax debt through a third-party agent, but there it requires a notice to have been issued before personal liability attaches to the third-party agent, and then the third-party agent must act in contravention of the notice. I think that would require an assessment to have been issued. Section 180 would also require an assessment, which is a personal liability for a financial manager, a person who controls or is always regularly involved in the management of the overall financial affairs. That also requires that the senior SARS official must be satisfied that their negligence or fraud resulted in the failure to pay such debt. In the Visser case, the Supreme Court looked at these other sections and it said Section 180 requires an assessment to have been issued by SARS. We've also got Section 181 that deals with the liability of shareholders, and also Section 182 that deals with the liability of connected persons in relation to a taxpayer, which either requires an assessment to have been issued or else that would have been issued had the taxpayer complied with their obligations under the Act. And then just lastly, I'll deal quite briefly with Thistle. If we could go on to the next slide. Thanks, Sibu. Thistle Trust. So just very briefly, what the Thistle Trust was concerned with was this issue about not how much was a capital gain, but who had to include the capital gain. Was it the trust or was it the beneficiaries of a trust? And it specifically dealt with the multi-tier structure. And so it was an interpretation of whether the conduit pipe principle was a general principle of application of the Act, and whether it's overrode, in a sense, paragraph 80 of the 8th schedule, or whether para 80 should be interpreted on its own terms, and so on. So that was really what this was about. And it was also about understatement penalties. I think the issue of understatement penalties in Thistle is probably just as important, if not more so, for most taxpayers than the underlying issue. So, see if we can go, I think, 2 slides ahead now. So the facts in Thistle, I'll just go through them anyway, were, I think, next slide, please. It was the 2014 to 2016 years that were in issue. And basically, Thistle was a vested beneficiary of a group of trusts called Zenprop. So the Zenprop disposed of assets. They vest the capital gains vested in Thistle, and then Thistle was a discretionary trust. And in the same year of assessment, it then vested those same capital gains in its beneficiaries. And the question was whether Thistle was allowed to pass the parcel with regard to those capital gains, or whether Thistle should have actually been taxed on those capital gains. So that was essentially the issue. With regard to the understatement penalty, Thistle, although Thistle had a tax opinion supporting their position, they argued that they'd made a bona fide, if the court found in SARS's favour that their tax position, i.e. that the trust wasn't the party that should have included the capital gains, but the beneficiaries would have been a bona fide inadvertent error. So if we just go to the litigation history briefly, the next slide. In the tax court, Thistle won. And in the Supreme Court of Appeal, they overturned that, and then SARS won. Thistle then applied for leave to appeal to the Constitutional Court, and the Commissioner applied for leave to appeal on this issue of the understatement penalties. So if we go to the next slide, in the Constitutional Court, the issue really was that revolved around this question of Section 25B and Para 82 of the 8th Schedule. Essentially, there'd been a change to the legislation in 2008, and the Constitutional Court seemed to rely quite heavily on that change. The change was to paragraph 82, and if you looked at the explanatory memorandum to the 2008 bill, it specifically said that the purpose was, in fact, to not allow in multi-tier structures such as this capital gains to be passed on to the ultimate beneficiaries, and that they'd have to be trapped in the intermediate trust and taxed there. And it seems as if the Constitutional Court placed quite a lot of reliance on that change. But if you just go forward, I think, to the next slide. So the Constitutional Court then found in favor of SARS on the main issue. I won't deal any further with that. On the issue of the understatement penalties, I think if you could go onto the next slide, Sibu, please. As I said, on the understatement penalties, SARS contended that Thistle didn't have reasonable grounds for its tax position. In the alternative, they said that they hadn't taken reasonable care in filing their tax return. And they said that essentially they would have taken reasonable care had they gone with our interpretation, which is which has been published by SARS, for example, in the Comprehensive Guide to Capital Gains Tax. Thistle, on the other hand, said that it was a bona fide inadvertent error. They had relied on the opinion of a senior counsel, and that the deliberate nature of their tax position was irrelevant to whether there was a bona fide inadvertent error or not. Next slide, please. You can actually go 2 slides ahead. So, on the issue of the understatement penalties, essentially what happened was, please, 2 slides, I think, slide 59 probably. On the issue of the understatement penalties, although the court acknowledged that it was an arguable point of law of public importance, they declined actually SARS's application for leave to cross appeal on this issue of penalties. They said that there were 2 things that made them decide not to grant leave to appeal. The first one was a lack of lower court analysis on the issue, because neither the tax court nor the Supreme Court had addressed the issue. What had happened was that in the tax court, the taxpayer had actually won. So therefore, the issue of understatement penalties fell away. In the Supreme Court, it appeared to the court, although this was contested by SARS in the Constitutional Court, that the Commissioner's representative in the Supreme Court had actually conceded on the issue, that in other words, that it was a bona fide inadvertent error. And what the Supreme Court said was that this concession had been correctly made. That was quite an interesting little word to use. It had been correctly made by the SARS representative. But then they also said that there was a weakness. There were weaknesses in SARS's case. They had failed to show that Thistle had lacked reasonable grounds because they'd taken legal advice. And they also found that SARS's argument that Thistle should have ignored its legal advice and followed SARS interpretation completely untenable. They actually said that it's based on the proposition that no taxpayer can act reasonably on advice that differs from SARS statements of its interpretation. The argument would elevate SARS to the status of an authority that can decree the only reasonable interpretations of tax legislation, and it is an untenable argument. So I think if you look at the import of this, it just brings out how important it is to have a Section 223 opinion. Taxpayers should have Section 223 opinions to support their position, right, if there's any doubt about it. Because, and just to refresh your memory, Section 223 opinions must be based on full disclosure. They must be issued on or before the date that a return is due. They must more likely than not support the tax position if the matter were to proceed to court, and they must be issued by an independent tax practitioner. But I think the important thing is that if you look at all the different categories of understatement penalty, based on what the Constitutional Court's reasoning was here, I think we do have to remember that it is obiter because leave was ultimately denied for the cross appeal. But still, their reasoning seems to have been that if you had a tax opinion, it would then not be a substantial understatement because it protects you in Section 223 against that. It would seem then not to be gross negligence, tax evasion, per the court here, reasonable care not taken or no reasonable grounds for tax position taken. The only thing it could then be in terms of the understatement penalties might be an impermissible tax avoidance arrangement. That's the only category that seems open to application. Anyway, that's the end of our presentation. I'd like to thank you all. I know we're a few minutes over and we've had our issues with technology, and I apologize for that. But I'd like to thank you all for staying the course. And just a reminder that CPD certificates will be sent to you, and the copy of the slides will be sent to you. So I hope that that you can get information and value from the slides, even if you weren't able to follow it during the whole presentation. And I'd like to thank all of our clients for their support during the year. And please encourage you to seek our input, BDO Tax Consulting, on any tax consulting issues that you might have. And I'd like to take the opportunity to wish you all a very pleasant festive season and a very happy new year. And goodbye from all of us. Thanks very much for attending our presentation this morning.